All right, I'm going to do a follow up on Atlas Engineered Products. It trades on the TSX Venture symbol AEP, around 122, $86 million market cap. Does not pay a dividend right now. This is a follow up. We've talked about this a couple of times on the show, and again, we've interviewed management in the past. Brennan just looked at them ahead of us interviewing them at a conference in person in Vancouver in September, I believe. So what does Atlas do? They design, manufacture, and sell engineered roof trusses, floor trusses, and wall panels. The company also distributes a range of various engineered wood products for use by builders of residential and commercial wood frame buildings. These include single family homes, townhouses, multi-story wood framed residential buildings, commercial buildings, and agricultural structures. The company's strategy is focused on profitability and organic revenue growth within its current markets, and Atlas is an active industry consolidator, having expanded inorganically to 8 locations from 1 in 2017. Atlas, again, is a company we do like but don't own right now. We continue to monitor it. We monitor hundreds of companies, however, though, so this does not mean we are looking to buy it in the near term, but it meets enough of our criteria to be interesting. Let's look at the stock performance year to date. Well, it is up around 9% on the year. It's down 28% from its year high. So let's take a look under the hood on the most recent quarter. You can see revenues rose 16.2% to 16.5 million. EBITDA represented an increase around 3% adjusted. Net income was around 1 cent per share after taxes, as opposed to around 2 cents in the same period last year. Let's examine those numbers a bit closer to see what's going on here. 15.2% Q3 revenue growth. This was powered by acquisitions. Organic revenue was actually down about 6.3% year over year, and growth related to the revenue growth overall was related to engineered wood products and walls. Atlas's push into wall panels was on display in the quarter, with the product line up around 119% year over year, representing 11.5% of total sales, up from 6.2% in the same period last year. While it was expected, we note that the negative organic growth continues to show softness in its end markets. There was underperformance in adjusted EBITDA relative to the revenue growth. This was due to tougher or softer market conditions that led to management kind of sacrificing margins for volume, a theme management called out on its Q2 conference call. More specifically, Q3 housing starts were down 6.2%. Two of Atlas's key provincial end markets, that being Ontario and BC, underperformed, dropping 17.8% and 8.4% respectively. Okay, let's look at the valuations right now. You can see this is based on first an earnings basis. It's 2 cents. It's slightly under 2 cents. That's why you see a P that's above. If you just did it on 2 cents, it's 82. And based on next year's earnings on an EPS basis, it's about 23.2. High valuations based on 2024 earnings, which are down year over year. There's an expectation of a jump in 2025, market dependent, and we continue to see a general slowdown in Canada. So this should be second half weighted if it does occur. Even on this, at over 23 times next year's expected EPS, the stock is not cheap near term, given the volatility and uncertainty in the market, in the construction market. The housing shortage should provide a ready long-term market, but we may find more attractive entry points in the future. On an adjusted EV to EBITDA basis, the company had about 9 times trailing, about 11 times next year, and 7.5 times 2025. We just think it's fairly valued given the uncertainty right there. Now, what are the positives for the company? Well, we start off with recent rate cuts. Quoting activity has increased, which should translate about 4 to 6 months out into better business, indicating potential return to growth in 2025. Growth margins should revert to Atlas's more normal 27 to 30% range from less than 25 by the second half of 2025. There's the growing housing shortage in Canada, which should provide a ready growth market for this company over the long term. There's also a creative M&A in the pipeline, and that continues to build. Management has indicated that, and we expect further acquisitions as this company moves forward. Quick conclusion here is we like the business and the long-term consolidation potential. We do know consolidators walk a very tricky line. Many can acquire, but to grow cash flow or earnings on a per share basis, it is difficult as the share counts can rise over time to fund that revenue growth. We will monitor this with Atlas. Again, like you can see here, I said good long-term growth, but it has leveled off and declined in the near term. We also note that near term, there is a delay in the LCS and high-tech robotics initiative estimates for revenue generation pushed back from this project into Q3 2026. As such, we just continue to monitor Atlas at present. The Q3 numbers were down on an earnings basis year over year, which was expected. We'd like to see growth returning again before we are entering into this company. Valuations, again, based on that, are fair in the near term based on lighter near term or weaker end term markets.
Yeah, and like this is one of those stocks where, you know, again, like I like the long term, thought behind the, housing shortage in Canada. But again, it's not to just buy a company based on like this individual theme. It all comes down to the fundamentals. Are we going to see weakness in, 2024, 2025 from the business based on earnings? Well, what the forecasted numbers show, it appears so. So, again, like Ryan was saying, it's just, trying to time to get into one of these, companies is, you really have to keep an eye on growth and what the company's, trading at for valuation, and not just, getting into a stock because you like a theme,
Yeah. And 20 times next year's expected kind of adjusted earnings for a, it's a great story.
Mhm.
That you can, it makes sense, but you're talking about an end market that is highly volatile. We saw that over the course of this past year. Profitability is way down, revenue is up because of the acquisitions, but profitability is down. You have volatility. A company like this typically doesn't get a premium multiple, and that, people are looking at the top line growth. It's getting a premium multiple going forward. So, I mean, there is some vulnerability if there isn't a recovery in the construction industry in Canada over the next year. If there's a slowdown, then there's certainly some vulnerability there. That doesn't mean that Atlas is a bad company. It looks to be a well-run company. We enjoyed chatting with management. They seem to be competent, but are the valuations where we want them to be right now to give us a margin of safety? They're not there right now, and we'll just say that doesn't mean it's a bad company. It can be a very good business and it may do well long term. We just want, a good entry point and growth in terms of earnings in the near term and long term. And, the near term is where there's some weakness, and we'll just be patient and continue to look at it. There's many companies we've looked at for 4 years and not bought and found more certainty in earnings on an outlook going forward, or seen that in the numbers, and then found a better entry point and entered. And some we will never enter because it doesn't meet our criteria fully. So that's that's why we stick to our very strict investment criteria.